So this is how U.S. gross domestic product breaks down. The four basic factors are, here you see consumption, private investment, net exports, and government expenditures. So you can see that consumers, or consumption, is the major component of gross domestic product. So when you hear things about growth, it's great and we understand it, what we're looking at, and we try to find trends in what's happening to these subcomponents. Because it is. There's a different dynamic at work depending on what's driving the growth in gross domestic product. Another way of looking at what's going on is looking at the Canadian fiscal position and the improvement of that vis-a-vis what's going on in the U.S. So what we've got here is the percentage that the U.S. budget makes up compared to its gross domestic product. So here you see right now we're at just over 7% is forecast out to 2014. Actually right now we're over 12% deficit as a percentage of GDP that the U.S. is running today, whereas Canada's is in much better shape. It's around 5%. So we're significantly better and projected to get close to break even by 2014. The U.S. is not. Part of that's due to the stimulus packages that have put out. Part of it is due to taxation and projections that the International Monetary Fund is putting forward. Question for the audience. There are only two countries in the world that are running a surplus budget compared to GDP. In other words, plus. Every other country in the world is running a deficit. I'll give you a hint about the two. So my question is, which ones are they? And I'll give you number 2 is Hong Kong. Hong Kong is running right now about a 3% budget surplus.
Switzerland.
Close. Not Switzerland.
Germany.
Not Sweden, not Germany. The answer is Norway. So Norway is running over a 9% surplus budget right now. Now, the similarities to Canada are oil, heavy dependency on oil, but also they don't have a heavy dependence on U.S. as a trading partner. And the U.S. is definitely, the downturn in the U.S. has hurt our capability here to run a more positive fiscal regime. Anyway, it's just an interesting note. Only 2 countries in the world running a surplus today. So back to the 4 factors. Growth is important because it's the way that we measure the improvement in our standard of living. That's why you hear so much about it. It describes for us how we're getting better every year. You'll hear a lot about per capita GDP, but it's that overall growth that's important. So when we look at what the factors are that are going to help a sustainable recovery or project a sustainable recovery, again, to recap, housing markets, consumer demand, bank stability, global credit markets. So let's look at some detail on it. U.S. housing market, if we look at a measure of the U.S. housing market, this is the Schiller 10-city composite house price or home price index. This is July 2004. That's when it peaked. On a year-over-year basis, home prices in the U.S. were increasing at a 20% annual rate. 20% a year. And this is what happened. When we got down, and this steep drop is down to January 2009, those house prices were dropping at a 20% rate per year. So this is why, and I'll get into what the connection is between house prices or home prices and consumer demand. What we're looking for, though, is the trend. We're trying to understand where the trends are going, not looking at shorter term. So by trend, I mean things that are going to impact markets over the next 6 to 24 months. What happens between now and 6 months from now is to a great extent noise. Things are going to happen. But when we're trying to project out how to put together a sound investment policy, we're trying to look 6 to 24 months out. So when I'm looking at these, we're looking for what the trend is like. And this is a positive trend right now. You can see we're up in July. The last numbers in July say year over year, home prices in the U.S. are increasing at about a 4% rate. Starting to be a little more positive. But here's the other side of the coin. And this is probably more critical once we start linking this to consumer demand. Going back, this chart goes back to 1999, we had a pretty consistent look from the owner's equity as a percentage of the home price. So the home balance sheet was around 60%. So what does that say to consumers? It says, I'm fairly wealthy. because I've got a lot of equity in my house. And remember the drop-off in home prices? What did that do? The impact of that was it made people feel less wealthy. And our behaviors as consumers are driven a lot by the feeling we have about our level of wealth. Academics have proven that. It has an influence on what we're doing. What we're seeing here is we're getting a slight upward trend, but we've still seen since, if we look back to here, which is 2006, an erosion of a third of the U.S. household wealth in a period of 6 years. So think about that in that context about generic consumers. Thinking that way about where they are today, that housing market impact has a very high impact on behavior of consumers. And this is what we're seeing sentiment-wise. So now if we shift to the second factor, which is consumer demand. One of the things we try to follow is what's going on with consumer sentiment. This gives us an indication about what the trends might be for consumers in the future. Again, that 6 to 24 month period. So this shows the drop-off. This is January 2007, and very steep drop-off. This is an index, so it's just measuring a relative change in consumer sentiment. What we're seeing right now, the August index value at 68, it was as high as almost 98 at this point in January 2007. But the important thing from my standpoint to look at here is this is a flattening trend. We're not seeing it upwards, it's flattening. So consumers are telling us, or U.S. consumers are telling us, getting better, but not great. So this is something that we're following. We're looking behind some of the headlines to look at what's going on. And this slide is about U.S. unemployment rates. So we're tracking these from 1994 to 2010, again to look for trends. This is what I call my first in the series you'll see tonight of economics geek slides. And I'll explain that. I'll explain why it's a geek slide. After I first show you that this blue line is the unemployment rate that you read about in the papers. So that's the typical unemployment rate. It's running right now around 9.6% in the U.S. Critical thing about this blue line is if you look over here, over the longer term, it kind of fluctuates between 4 and 5%. So that's what economists call frictional unemployment. You just don't get lower than that. Part of it's due to geography, people need to move. Part of it's due to training. You just won't get below 4%. But the critical thing, and by the way, 4 weeks ago, a group of economists announced they now think frictional unemployment in the U.S. is 5%. So they're looking at raising it just because of the structural problems that have arisen of so many people being unemployed for so long. It introduces a different dynamic into the employment market. So again, look at trends here. This is starting to level off, but still at a relatively high rate. Now the reason I'm calling this one of my economics geek slides is I like to put in this line, which you never hear about. This top line is what we call U6, unemployment level 6. The one you hear about all the time and you'll read about in the papers is U3. So it's a mid-level unemployment rate. U6 also captures people who stopped looking for work. Now I don't know about you, but I think somebody who stopped looking for work is still unemployed. But those numbers are not reported to us. What we see are the numbers at U3. So if you're unemployed and have stopped looking for work, this number doesn't capture you. So this is why we're following this number as well to look for trends to see whether or not employees are coming back or potential workers are coming back into the marketplace. The historical perspective is during the Great Depression, U6 was the way we measured unemployment. Well, I didn't measure it. I wasn't born then, but it was the measure that was used then.